I'm going to look at S&P 500. Now, you're all going to be experts in the head and shoulders pattern by the time I finish with you today, because this is also a potential head and shoulders pattern that I'm seeing here. So E-mini S&P, let's go back to the weekly chart. I'm sure you all know that the S&P has been in a bull run for eternity. This chart goes all the way back to 2009. This is the global financial crisis. Right. I was talking about the global financial crisis and about how there was a pattern that told me the stock markets were going to crash before they did. I'm going to also show you some patterns and show you why. This is a monthly chart. So the peak of this is October 2007. The global financial crisis, I think, broke around September 2008. Yeah, this was the Lehman's moment. Now, if this was the beginning of the global financial crisis, the Lehman's moment, you can see the market had already come down quite significantly. So the S&P had come down from about 1577 to the peak here, 1308. It had already come down 250 points, which was a significant amount. 15%. No one was talking about the stock market crash. There was a head and shoulders pattern here. Can't really see it very clearly on the monthly chart. I need to get it on the weekly chart. But look, it went something along the lines of this. You can't see the right shoulder here. It's all disguised in a couple of candles. But take my word for it. We had like a left shoulder ahead and a right shoulder. We broke below the neckline. We retested it and the market collapsed. I'll try and get it on the weekly chart in a minute. So by the time the summer came, the market had already completed a head and shoulders pattern. And I was already talking about how the market was going to plunge. And there wasn't really that much going on news-wise. I was telling clients like Deutsche Bank, I don't understand what it is, guys. I don't know why, but it looks like the market is going to take a serious move to the downside. And they were all like, well, why? You know, it doesn't make any sense. There isn't anything out there that's going to cause this. I said, I don't know. I'm just telling you there's a head and shoulders pattern. And in those days, people were like, what the hell's a head and shoulders pattern? 15 years ago, there weren't that many people doing technical analysis. I was one of the first people to provide it as a daily service. It was this pattern that told me that something serious was going to happen. And in the end, the stock market did plunge to 664, according to this chart. That was a 60% drop. That was absolutely huge. And in such a short period of time, June 2008, March 2009. So you're talking about, what's that, 8-9 months where the market dropped significantly. That was a hell of a crash. Let me just see if I can get it on the weekly chart just to know if I can show you the pattern a little bit more clearly. Now you can see it. Yeah. So I actually got the neckline wrong, to be fair. The neckline was actually here. And I was actually trading at this time. Just learning technical analysis. Okay, so that's actually a head and shoulders pattern. Now look, I could say that the left shoulder began building in March 2007 and completed in August 2007. So that's a 5 months shoulder. The head was built from August to November. That's 3 months. And then the right shoulder was obviously a lot shorter. But from March 2007 to January 2008, so that pattern was built over 9 months. So it's a pretty significant pattern. And then we broke to the downside. We came up, we retested the trend line. We didn't quite get to the neckline. Head and shoulders patterns often retest the neckline, by the way. And then, bang, we collapsed. I'm just showing you this because I wanted to show you how the technicals here were leading the news. And it wasn't until here that the Lehman's crisis hit. Now, the Lehman's crisis only hit because the stock market was down 15%. They were over leveraged. And as Warren Buffett says, you only find out who's swimming naked when the tide goes out. Well, they were swimming naked. And at this stage, they couldn't sustain any further losses on whatever positions they had on, which were over leveraged. Okay, back to where we are. Daily chart. So now I think we have a smaller potential head and shoulders pattern on the S&P. I say smaller because it's only built up from June till now. So we're only talking 2 months. It's not going to have the significant effect that the head and shoulders pattern that I showed you in 2007, 2008 had. But I do wonder if the S&P is forming a head and shoulders pattern. And it's very clear. This could be sort of the left shoulder, small one, head. This could be the right shoulder, depending on where we peak on this little run up. Now, in order to suggest some parameters where we might peak, I'm going to put my Fibonacci levels on here. There you go. There's the neckline. There's the That's the beginning of the head with the neckline joined up. Now, if I put my Fibonacci levels on here, there you go. Okay. So you can see that the market has recovered 50% of that very steep loss from 27th of June to the 18th of August. So I wonder, 50%, is that it? Is that enough? I mean, we've hit it bang on. We've got a red candle on the 4-hour chart, and we're maybe breaking back below the 100 period moving average on the 4-hour chart. And even if we get up to 4,500, which should be a good resistance level, 200 period moving average, 61.8% fib, and a really decent swing high there as well. And you can see we're coming into a congested area here. So look, basically anywhere from 44.75 up to 45.05 could be a resistance area. And when you go back to the daily chart, that would make a fairly symmetrical head and shoulders pattern if it were to play out. So if we peak here, that would be really nice because that's around the peak of the first shoulder. But these things don't have to be symmetrical. We could even stretch as far as 45.05 and then turn around. And if we do, and we start breaking below the neckline at 43.35, which is also going to be where the 100-day moving average is going to be by the time we get there, because it's rising slowly, really is going to be a very big level around 43.35, and we break there, then we have an important sell signal similar to the one that I think I'm seeing in oil, and that would mean that the market could drop close to 300 points, which would take us down to 40.50 to around here. Big drop. Only a correction, but still a big drop. Now, I want to put some fib levels on here just to see if that target is realistic as far as fib levels go as well. I haven't finished yet with this chart. There we go. I've taken the swing low here, and it is a significant swing low. I always take the low of the wick, whether it's for a trend line or for a fib level. I believe that you should encompass all the data. Some people only take the body of the candle. That doesn't make any sense to me. Why would you miss out a chunk of data? If maybe I'm wrong, but that's the way I see it. Okay, so yeah, there's my fibs. Now, when you look at this on the daily chart, the 23.6% fib is 43.51. This little swing low of this bar here was 43.34, and this and the previous and the low we've just had was 43.35. So that's why we bounced. We retested the previous swing low and bounced. And I just have this feeling this is going to be a head and shoulders pattern. You could argue that it was the 23.6% fib in the previous swing low that was the support zone. Fair enough. And we bounced off it. I was actually buying into a long position down here for that reason. So, I mean, it was fairly obvious. Myself and subscribers were getting in. Actually, I posted a video on it. So if you don't believe me, I even posted a video on my YouTube channel. So there's proof, time-stamped proof that I was saying buy here. And I was saying that the target was up around the 44.40, 44.50 area. Why did I say that? Well, just because that was a 38.2% fib. You know, don't have to be the best technical analyst in the world to pick that as a target. It's fairly obvious. Even the support level is fairly obvious. My techniques are dead simple. So this area is going to have increased importance with the 100-day moving average as a support if we retest it. If my theory is right, that we build the right shoulder and the break below there will take us to 41.86. Now, that's going to be a relatively good support level. That might be the correction. It's a good support level. Look, swing high there, swing high here. So the price action backs up the fact that 38.2 is going to be a good support level. By the time we get there, the 200-day moving average, which is now at 41.53, I'm sure will be around the 41.85, 41.90 area. I don't know. We may only drop 145 points. But obviously that would still be a pretty significant drop and enough to make a decent chunk of money. Take the top of the head, 46.17, to the low of the right shoulder, 43.35. You take that as your projected target for the move down, which is, I'm going to call it 315 points for simple maths. So that would take you down to 4,010. So basically 50% fib would be a target, the measured target, if we were to get that far. I would be taking some profit here because there is a danger that we bounce. And we could even bounce to retest that resistance level and then dump. So, you know, I'm not saying we're definitely going to get here. And I would be trading it along the way. I'd be taking action as I see fit, as the chart develops along the way. And I'd be looking at the 4-hour chart as well. So I just have to react and see what the price action tells me as we go along.